All right, well, thanks. Mike, are you okay for me to kick off and then hand it over to you?
All set.
All right, well, so first of all, thanks, Eric and Anita and the UACI team for inviting us to come and present with all of you. We're excited to be here, and our goal is to make this as informative and interactive as possible. So all questions at any time welcome. And it is so exciting to see so many of you. Just sort of a really quick deviation. About a year ago, I ran a venture development effort for the University of Arizona. So many of you are friendly, familiar faces, and I'm now stepped into this role. So I serve as the CEO for the Desert Angels. We are a local angel investment group, and we're pretty active. In fact, according to ARI, the Research Institute for ACA, we were ranked #1 in the Southwest region and #8 in the country in 2019 as being most active angel groups. Unfortunately for Mike, that means we get over 1,000 applications for funding every year, and he might talk a little bit about that. But we just did a look back study, and our members invested about $47 million into just under 100 companies. And I'll talk maybe just for like 30 seconds a little bit about what that means. So we are a nonprofit organization of accredited investors. And our role is to help facilitate that connection between a company and those investors, right? And we have a pretty rigorous process that we go through of screening those applicants. We have a monthly screening panel meeting where we might see 6 to 8 companies, of which we might select 1 to 2 to go to a full member meeting. And those member meetings are typically over dinner at Hacienda, although right now, because of COVID, everything is over Zoom. And Mike leads that that side of the house, those efforts in terms of the applicants and screening of companies. Our members make individual decisions on how they invest. So even when a company goes through the screening and the dinner meeting, they'll still have follow-up conversation and additional diligence efforts that they may take before the member makes the decision to actually write a check. And we can talk a little bit more about that at the end. The last thing I want to say is that we really serve companies that are working on new innovation in science and technology across all industries. About 40% of our portfolio of companies fall into the life science space. That's everything from deep pharmaceutical and therapeutic to digital health. Another second large part of our portfolio is in software as a service. And then for the rest, we do materials, optics and engineering. We've done a couple of consumer goods. So pretty much a whole range of projects. And so our members reflect all of those industries. So we have that kind of depth and expertise in our membership too. Right now we have, we range between 75 and 125 members at any time, and they are accredited. They are required to make investments. So we know that when we do have these meetings that we're all active and engaged. And the very first step, if you're thinking about applying to the Desert Angels for funding, of course, is to fill out an application, and any of your UACI team can help you walk through the process and answer any questions. But that's not really why we're here today, as much as it is to hear about, kind of the next steps. What do we look for? What does the term sheet look like? What do the financials look like? And then, of course, to hear questions from you. So I'm going to stop there, and I'm going to kick it over to Mike Sembers, who is the chair of our screening panel. Mike is also a member of our board and has been with the Desert Angels for a very long time. And I'm going to ask him to tell you a little bit about his background and then kind of jump into the conversation. So Mike, take it away.
Okay. Yeah, just truth in advertising. When Joann ran the venture group at TLA, I worked for her. And it's just like having a bad cold. I can't get rid of it, so I'm not working for her at Desert Angels.
Wait, did you just call me a cold?
Yeah, something like that.
All right.
So apologies, I was going to do this with a headset, but on the last call, my headset died, and Joann probably knows why. My puppy ate right through the cord, so I have to go get a new one. So my background, just very briefly, I've been in the pharmaceutical and biotech space for essentially all of my career. A little bit lesser amount of time spent in medical devices. I have worked for several big pharmaceutical companies, including Mary Merrill Dow, which is now Sanofi, and Elan was an Irish company that was actually quite well known at the time. In recent years, when I came back to Tucson, I've done a number of things, including running Biosa for a while, which is, I think, the first time I met Joann. And I've been involved as a mentor to a lot of companies here in Tucson, particularly in the life science space. That's my expertise. So with that, why don't we just get into it? I was told that the topic today is going to be term sheets. I think last time we talked a little bit about the things in general that we look for. So term sheet discussion is a bit more specific now. And with that, I'm going to try to share my screen. Let's see. Can you see my screen? No.
Not yet. Oh, there it goes.
Okay.
Perfect.
Right. So let me see if I can get that to presentation mode. So, starting with the basics, what is a term sheet? Well, the textbooks and the articles you read in the literature say it's a non-binding agreement, shows the basic terms and conditions of an investment. That's a little bit misleading because sometimes a term sheet is binding. Having said that, that's relatively rare in our world. And I recommend, for the most part, that companies not get involved with binding term sheets. And there are reasons for that we can talk about as time permits. The term sheet serves as a template and a basis for the more detailed and often quite voluminous legally binding documents. Hopefully the final contract comports with the actual terms in the term sheet, but that's not always the case. So the goal of this process is to end up with a partnership, and a happy partnership, between what is inevitably the more powerful entity in this relationship, i.e. the organization or individuals that are providing investment funds, and the company. So you're all familiar with Tom and Jerry. Tom was always trying to outwit Jerry, and Jerry inevitably actually won. So it just goes to show you, just because you're reaching out to a more powerful, established entity, it doesn't mean that you can't win in this process. So that's the goal. The reality of it is, it's actually often quite contentious. That powerful entity will at least be perceived, if not in actuality being, somewhat egregious with respect to the terms that they're offering, their inflexibility, et cetera, et cetera. And one way to think about that is it's sort of the bad versus the good, evil versus the virtuous. So what are the elements of a term sheet? Well, there are certain key things that you always expect to see. And I'll talk about these individually in a second. But the first thing is, it defines what are the securities which are being offered. In other words, you're going to collect money from an investor. What are they getting in return? Whether it be a convertible note, a priced equity round, or some other forms of ownership in the company. Excuse me. The term sheet will define the valuation, in other words, the price that they're paying, and then applies, of course, the valuation of the company. Often quite extensive discussions in the term sheet, but particularly in the definitive deal docs about shareholders' rights, shareholders' protection, and then some other matters. So we're going to start first with convertible notes. We say at the Desert Angels that we don't like convertible notes. We prefer to do priced equity. We don't like them. Passionately, we don't like them. But having said that, I believe 70% of our deals, or maybe that number's higher, Joann, you can correct me, actually do involve convertible notes. So we don't like them, but we do them all the time. So convertible notes are usually a form of debt. Sometimes they're preferred stock, which is kind of an in-between debt vehicle and equity, but most of the time it's a convertible debt offering. And essentially what it means is it converts to equity at some predetermined point. The convertible notes include conversion terms. That's usually structured as a discount to a subsequent round. So we're going to raise money today. If you invest, when we do our next raise, you'll be able to convert at, let's say, for example, hypothetically, 80% of the price of the round that we engage in next. They do contain terms of maturity. You know, when will this thing expire? And oftentimes maturity is structured as when the conversion will take place. But it's important in a term sheet that you talk about the maturity when it does convert and what happens if it doesn't convert. In other words, if there's triggering events, if those events are not met, you know, what happens to the note. We'll also talk about a valuation cap. And the reason that we talk about it that way is that most people who are offering up convertible notes, most companies, are trying to do it to avoid the hard discussion of valuation. So we'll talk about equity in just a minute, but when you're selling equity, if you will, you know, there's a price per share, et cetera, and it's well defined. The theory is that convertible notes allow you to avoid that hard valuation discussion, particularly at an early stage when you're a startup company and it's pretty hard to agree on what a valuation is. Now, having said that, the Desert Angels, and I think most angel groups, try to minimize that issue to some extent by asking for what we call valuation cap. In other words, we don't actually put a definitive value on the shares or the shares that it will convert to, but what we do is we set a limit under which our shares will in fact convert. So it's called a valuation cap. Our policy at Desert Angels is to not do a deal that does not have a valuation cap. Some firms that are out raising money, particularly if they're doing it at an early stage, and this is something we typically refer to as the friends and family round, they don't put a cap on the note, and that's something that we will push back hard on. And in fact, I can say categorically, we will not do a deal without a cap. So priced equity, what's this? Essentially, think about this as like on Shark Tank. When they go in front of Shark Tanks, and the first thing the sharks ask is, how much money do you want and what percentage of the company do I get for that money? And typically that's in the form of equity. They're buying stock in your company. And that typically takes two forms, although there's all kinds of variations in this, of course, as in anything in life, but there's common shares versus preferred shares. Most angel investors and VCs want preferred shares. And I'll explain that in just a second. Common shares are usually reserved, at least initially, for the founders and potentially employees of the company. But investors, particularly at this stage, will want this preference. And the preferences are more than just a preference on liquidation, but that's the first thing that comes up. So what does that mean? What that means is, well, first of all, let me step back. So I don't know how many of you are familiar with the hierarchy of liquidation, but essentially the way it works is if a company is liquidated, in other words, it's going bankrupt or otherwise dissolving the assets of the company, there is in the law, there is a hierarchy of who gets paid first. And true debt holders get paid first. The second category are preferred stockholders, and the third category are common shareholders. So angel investors, VCs, they want to be above the common shareholders. And it's actually quite often the case in the event of a true liquidation, the common shareholders, after these monies are paid out to any debt holders, if there are any, and preferred share investors, there's almost nothing left for the common shareholders. So that's why angel investors and VCs want that. Other things that are usually attached to these preferred shares are voting rights. We don't want, for example, the other shareholders, including the common shareholders, to be able, after we do the deal, to take a vote and diminish the value of our investment vehicle. So typically you'll see in a term sheet language that says we vote with the common shareholders, but on matters pertaining to the underlying equity of our holdings, i.e. the preferred shares, you cannot change those terms without our full consent. And that's the standard. And then the other thing about priced equity, as I said before, is that it does more clearly establish, less ambiguously establish company valuation. So shareholder rights. And as I said earlier, these are often pretty voluminous sections of the full documentation of the deal. It's customary to have these in a deal. And what is articulated, it's a whole range of things, but some of the more important ones I've listed here, and that includes voting rights. And I think I've already talked about that. Anti-dilution, meaning, you know, if I buy your stock for $1 and you go out on the next raise and you sell shares at 50 cents, what happens to the valuation of my shares? And so typically what investors will seek is the anti-dilution protection. Shareholders want to know what their rights to transfer these shares are. Typically, the company wants those rights to be limited. You don't want your shares to be freely exchanged, particularly with entities that you don't know at all. But they want some rights to transfer. So that's a negotiated term, and oftentimes is quite extensive part of the negotiation process. And then finally, it's almost always the case that these shareholders want to be able to participate in dividends. So if the company's common shareholders declare dividends, then they will want the right to participate at least pro rata in those dividends if and when they are offered. There's also a category called shareholder protections. Sometimes these two things kind of blend together. This is, again, the right to protect their class of shares. It usually includes things like right of inspection of corporate documents and financials. Will sometimes include the right to a board seat, or in other cases, an observer seat. And it will also include what are called restrictive covenants. So in other words, things you can't do without my consent. So you can't raise money for me to create the next pharmaceutical company and decide that you're going to invest that in a local dry cleaning shop. You know, I can guarantee any smart investor is going to include covenants in this in these deal docs, which will prohibit you from doing that. The other thing it talks about sometimes is the other uses of funds. So you can't just go into the dry cleaning business, but you can't loan money to your cousin. You can't take on debt over a certain limit. So there's all sorts of covenants that you'll see crop into these deals. Again, these terms are negotiated. And then the last category is what we call other matters. Typically, the term sheet defines the rights to diligence. In other words, it says we're going to enter into this term sheet, but before we consummate a deal, we have a right to do full diligence. And that includes the right to look at every nook and cranny of your company. Typically, investors want what's called exclusivity, or sometimes phrased as a no shop clause. In other words, they don't want to enter into a term sheet with you and have you out there negotiating with another entity for a better deal. So typically, you will have to stop any of those negotiations while the term sheet is being fully negotiated, until such time as either you enter into a deal or you terminate the term sheet. And then one of the other items, and this is always a big one, is investors typically want the company to fund their fees for entering into this transaction. It comes out of proceeds, but it's one that sometimes creates quite a lot of pucker factor here because it can be pretty substantial, particularly on the legal side. So I mentioned before, the negotiation process can actually be quite onerous at times. But notice who's smiling in this cartoon. Jerry's smiling, right? He knows, even though he's the smaller entity, the less powerful entity, he's smarter. He's going to be able to outsmart Tom. And that's the way to think about, I think, in most cases, the negotiation process for your companies. The key thing here is Jerry knows he's got the ability to say no. And that's an important feature of this. When you're negotiating these term sheets and then subsequent deal docs, you need to know when enough is enough. And you need to know when to push back, even if that means walking away from the deal. So, some common pitfalls. Oftentimes you'll see these dividends discussed. You want to try to limit the time frame when dividends can be paid. You also want to try to seek non-cash dividends. This is not atypical for a startup. Most investors know you don't have the ability to pay dividends in cash, so they will accept non-cash dividends, but it's an important thing that you can't forget in the negotiation process. I mentioned before anti-dilution. This can be a tricky one. I don't see it as much anymore, but it was actually quite common 5-10 years ago to see what we called full ratchet anti-dilution, meaning all the shares get reduced in price. And that's a real no-no. So you want what's typically called weighted average, and we can talk about that later. You also want to avoid giving investors drag-along rights. Drag-along rights are, I want to do something with the business. I'm a major investor, and all the other shareholders have to go along with what I want to do with the business. That's something you want to avoid at all costs. You'll see sometimes excessive liquidation protections asked for. 1 to 2x is usually enough. Typical starting point in most of these deals is 1x. That means they get their money back in the event of liquidation. Sometimes they want twice their money back. And if you go beyond that, I think that is becoming in the category of what I would call egregious. And then finally, participation rights. This means if you, the company, goes out and raises subsequent investment runs, they want the right to be able to participate in that run. And so my view on this is that you'll probably end up giving up that right, but that right should be pro rata, not be greater than pro rata. Pro rata is whatever their current ownership position is in the company. However, we do know some firms that seek more aggressive participation rights. I'm not going to mention any names because Joann will be mad at me. But we do know one equity firm that deals with university startups. It starts off by demanding 10% irrespective of what they own. So in other words, if they own 2% of the company and you go out and raise a round of funding, they want the ability to participate up to 10%. I've had some discussions with those people and others about this topic. I asked this firm in particular, and again, I'm not going to mention names, but I asked them, is this something you typically get? The answer is no. They usually give it up right away. So why do they ask for it? I don't know. That's a matter of philosophy. Another point, the power of the pen. She who drafts is in the best position. So when it comes to term sheets and definitive docs, it's better if you can draft, but that's pretty unrealistic. Most of the time, the term sheets are drafted by whoever's contemplating the investment in the company and their lawyers. But if you are able to do that, that's a good thing because, as I said, it's the power of the pen. But if you're not able to do that, it's important that you articulate your key pressure points up front. You need to see the deal from both sides, know when to give and take. And by all means, make sure you have an attorney. I meant to actually put that on the slide. You should have an attorney review the term sheet every step of the way. Some other comments: be nice, even if the other side isn't, but don't be too nice.
Will you show the previous slide very fast?
I'm sorry?
Will you show again the previous slide?
This one?
Yeah, that one, yeah. Thank you.
Sure.
You.
Question about it?
Oh yeah, I reserve the question after you finish. Or do you want the question?
I'll take it now, yeah.
Actually, the question was on the previous slide, but it was regarding the Proradar.
Yep.
So the question will be, if you have executive that you think their background will help the company and you give them a certain equity, do you give them along the equity the participation, the Proradar participation or voting right? Is that like a common practice?
Yeah, it's pretty common. Just about every organized investment group, including angel investors and VCs, will ask for these participation rights. Friends and family, maybe not. But yeah, it's actually pretty common to ask for these.
Okay.
And as I said, sometimes they want it to be more than just pro rata, but typically what I see is pro rata. Did I answer your question?
Yes.
Thank you.
And Mike,
Okay.
there's a couple more questions, if you don't mind.
Sure.
One is—
Why don't we go to that? Actually, I have a couple more slides and then you want to just go to questions?
Perfect. Excellent. Let's do it that way.
So I also was asked to talk about the cap table, and I'll do this very quickly. Cap table, or it's short for capitalization table, shows the overall capitalization of the company at a glance, lists the holders by class, i.e. common, preferred, debt holders. What we look for is we want to see that management is properly incentivized to grow the company. In general, it's okay to just present summaries, in other words, classes of holders, but sometimes, particularly sophisticated investors, if they're thinking about investing in your company, they'll actually want to know at the granular level who the investors are. And in most cases, you're going to tell them. You may have to seek consent from your investors to do that, but that's often an important, they want to know, investors will want to know, who am I co-investing with? And we expect to see a stock pool for employee new hires. The other thing that we do expect to see is financials. Distinguish between actuals and prospective financials. We look at cash on hand. We look for realistic but optimistic projections. We want to see realism, not only in projected revenues, and that's common to get, very good, very favorable projected revenues. What's less common is to get, prospective expenses articulated in quite the same way. So we will dive into that to see if it's fairly balanced, and we'll ask about your capital expansion plans. Finally, we want to hear about exit possibilities. We want to hear that the owners have a willingness to exit. We want to look for comparables, deals that are roughly analogous, and what the specifics of that were.